Hell is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Morgan Stanley warns that when this goes to zero, all hell breaks loose. And this is something that most investors have never heard of or even understand. But as you're about to see, when this goes to zero, many believe it will rock the foundation of our entire financial system. Plus, we have a sponsor for today's show. Caliber Mining is back. You can find them on the OTCQX under the symbol CXBMF and on the TSX under the symbol CXB. They just completed a major acquisition, and there's been some huge buyers coming in underneath this stock that are about to send it up 15 to 32%. And the best part is, I'm going to show you exactly how you can take advantage of this move. Stay tuned to the end of the show or check out the pinned comment or description below for more information. Now let's head over to Morgan Stanley to find out what they see as something that could shatter everyone's reality. And they say that QT will end, but not all that soon, and neither we nor the markets expect a policy move at this week's Fed meeting, but no doubt we will all be looking for hints on QT. Now you might be wondering, well, wait a minute, this must be a good thing. In fact, of course, many people do believe that the end of quantitative tightening would be fantastic. It's what is going to come at the end of March, or an estimate around March, that's going to shatter everybody's expectation of just how solid the U.S. financial system is, because many believe that this is going to be the catalyst, and it's not QT. Hang tight. Let's dig a little deeper here, because nothing explicit is likely at the policy statement, but Chair Powell may be asked about it. And our outlook is why the FOMC may start the discussions around tapering as soon as this meeting. Tapering itself is still a ways off, and that they think the QT will end sometime early next year, but many are now making the case that sometime around March, because there's a reason the market is pricing in rate cuts as soon as March, because there's something else that is about to happen then that's going to go to zero, and it's going to test the entire fabric of our financial system and banks. And we already know that many of the small and mid-sized regional banks are insolvent. Some believe this is a catalyst that puts them into complete insolvency and causes the Fed to backpedal, slash rates, and bring back QE in a big way. In January and May of 2022, the FOMC published the principles and then the plan for QT. The fact of a taper this year is not news, because there is one overriding factor. The Fed runs out of bonds to maintain the current pace, so at some point there was already expectation they were going to have to taper. The fear now is they're going to have to come out with a complete policy reversal. But let's continue on, because we're going to make the case of why in March this is going to likely happen. And here we can see that President Logan and Governor Waller reinforced preference for the reverse repo facility. This is something that most investors have never heard of, to be drawn down to zero. And we infer that getting the reverse repo near zero will be the starting point for the taper. Of course, this is what's coming in March. So something called the reverse repo is going to get to zero. Now, many people believe this is absolutely critical to the health of the financial system. And let's take a look at a chart here, because overnight reverse purchase agreements, well, they went up big time in 2021 all the way through 2022. Many believed they were going to stay elevated, and now these are coming back, and based on the current trajectory, this is going to head to zero. And this is what's causing some concern around Wall Street right now. This is why we're hearing the market price in a cut in March, even though the Fed is adamant that there's absolutely no way they're going to cut in March or even the first half of this year. But the issue now is when reverse repo gets to zero, well, we're going to find out that perhaps the banking system isn't as solid as everyone's hoping. And historically, the FOMC has taken at least 2 meetings to finalize these types of plans, and the December minutes stressed a desire to give the market lots of advance notice. As a baseline, we think the FOMC announces the parameters for QT at its May meeting and enacts a taper in June, thus cutting the runoff in half, and mainly because the Fed's reverse repo facility has been declining rapidly, and that timing could shift earlier by a month or so, putting us on target for perhaps March runoff of reverse reverse repo to zero, and that change of shedding $30 billion per month in treasuries would slow the pace of the runoff materially, but there's clearly a chance that the subsequent pace is even slower, as the Fed may have to even come back and transition to QE. And this puts into perspective of what is this reverse repo and why is it so critical? Well, right now it has everything to do with money market funds. So when you put money into a money market fund, they pay you interest. The question then should come is, where do money market funds get interest from to pay the people that give them their money? Well, they go out and they buy short-term treasury bills. The problem is we went through a period where there wasn't enough of them. There's a massive collateral shortage. There's such a huge collateral shortage in our system. And now what we're seeing is a wind down of this. The problem is, where is this money coming out of? Well, it's coming out of the banking system, and that's a huge problem as investors continue to chase higher yields, yanking money right out from underneath the banks, which are desperate for money. And that is starting to set the stage of what could be the revival of QE as the banks hemorrhage from a loss in deposits. But one other factor here could be a decline in inflation, as this is the consumer price index against U.S. regular formations gas price. The Fed could simply come out and say, look, we need to taper QE because we're going to start initiating rate cuts because we're on target now to hit what we think inflation needs to be at 2%. For one simple reason is the Fed has already been very clear that they've gone into a restrictive pace with the tightening and they're going to have to scale back. But we heard before from the Fed that they're going to maintain QE despite using rate cuts. Many believe that that is not going to happen at all because the Fed is going to find themselves chasing inflation to the downside. But the QT effects on the banking sector, well, there could be very severe. And why the intuitive notion is that QT must destroy deposits is widespread. Now, this is a major problem because banks need deposits. Now, the question is, how is money created in our economy? Well, it's very simple. When banks originate new loans, and we'll look at this data later in the show, money is created and thus a deposit exists. So if the Fed is indeed destroying deposits, well, you think back to the small and mid-sized banks. What is their biggest issue they face right now? It's deposits. They can't get them. They can't keep them when they have them because the challenge here is people are exiting those banks in a big way. We're not creating enough loans to keep them intact. And what's the other factor that's coming in March? Well, hang tight. We'll get to that in a minute. And they've highlighted that the data would show, in fact, that deposits have edged up a little bit, not down, in recent months as QT has progressed, but that's going to change in a major way. Because one thing we look at this chart here, you can see deposits in red against total assets. This is the Fed's balance sheet. So you see the Fed's balance sheet is getting unwound, and deposits have somewhat plateaued here. And we've noted in the past that there are ways for banks to get deposits, even though they're leaving, and they can go to the wholesale markets and effectively buy them. So we don't know exactly where some of these deposits are from, but as they note here at Morgan Stanley, they can always choose to bid for wholesale deposits. So instead of focusing on the quantity of money and how that changes, the better question is how bank funding costs are evolving. Of course, we know the banks can't afford to buy all of this stuff. Now, maybe the major banks can. They have plenty of cash that we've seen during the earnings. It's the little banks that are the problem because they are desperate for deposits in a big way that they've been going to the Fed and trying to get them. So the next step is for the Fed to shift from talking about tapering QT to actually talking about capering. And only after that step will we start to look for the end of QT, which the Fed will determine with an eye on the money market conditions. Comes back to that overnight reverse repo. In particular, the Fed is looking to whether SOFR is trading below the rate Fed pays on reserves, in which case it will likely judge conditions to be accommodative or well above the rate the Fed pays on reserves. So if we see a simultaneous blowout in the SOFR rate, at the same time we see the reverse repo come to an end, what it's telling us is there's big accumulation of stress in the banking system. But there's another factor here that we have to look at first, because now we come to Janet Yellen, the Treasury chief, and she's got a lot of debt to issue. And if the economy is digesting these massive amounts of QT at a time where she's about to increase our borrowing due to deficits in a big way, well, as many have suggested, and we've noted on the show is not true, that a lot of debt issuance leads to higher rates. Well, of course, we know the government at this point, they don't need rates to go any higher. In fact, they need them to go down. As U.S. Treasury seen boosting long-term debt sales one last time, as most dealers see refunding auction getting a third straight lift. So you think about the timing of what's going on here is the Fed, who has said in the past that they were in no rush to reduce their balance sheet. They almost needed a reason for it. Well, they're going to get that around March as overnight reverse repo gets near zero there. It's going to start to put some stress on the banking system. And what could you give the Treasury as a gift from the Federal Reserve that they desperately need? Well, it's cutting the amount of bonds you're dumping back into the economy to make room for all the debt Janet Yellen's about to issue. And the Treasury Department is expected on Wednesday to follow through on its November guidance of a third round of increases in the so-called quarterly refunding auction of both notes and bonds. And that would put the total at a whopping $121 billion, suggesting, well, the Fed needs to do something to take the pain off. And with the Federal Reserve increasingly expected to slow or halt its reduction in holdings of treasuries, U.S. debt managers face the prospect of relief from having to tap the public for more of its financing needs. And nevertheless, a historically large budget gap means the era of giant auctions, some at record sizes, is here to stay. So you think about exactly what's going on here is the Fed needs some reason to taper, and the overnight reverse repo perhaps is going to give it to them. If we start to see a blowout in SOFR rates, it tells us stress in the banking goes up, system goes up, and the Fed starts to react. And if they can nail this and smooth it out, well, it could be a huge plus for the Treasury. As Janet Yellen's debt managers turned to bills recently, which mature in 1 year or less, for the bulk of the rise in borrowing needs last year caused by the Fed's QT and the deficit. Bills now make up about 22% of publicly held debt outstanding, exceeding the 15 to 20% range recommended over time by the Treasury Advisory Panel. So you wonder what is causing this overnight reverse repo to draw down? Well, remember, this all comes back to money markets. And if you look at the money market laws, it says exactly the type of securities they can own. Now, it doesn't specifically say they have to buy T-bills, but there's only one type of investment that fits all of the requirements that money markets can buy, and that happens to be T-bills. Well, Janet Yellen's been giving them a whole lot of it, and they've been jumping on it. The only question then is, what happens when we get to zero? And any overfunding that materializes from quicker tapering of the Fed's QT, which currently has the central bank allowing up to $60 billion a month of treasuries to mature without replacing them, quote, would probably initially for the year be adjusted through cuts to bills. And that is a problem because then we get back to the collateral shortage in the banking system, and that starts to key off a domino effect, as Zero Hedge pointed out. In addition, the Fed made clear the entire bank term funding program is being scrapped on March 11th. So now in March, you have two events happening. You have the bank term funding program ending. And why has this been so critical? Because the small and mid-sized regional banks in particular need cash. And how have they been getting it? By going to the Fed and swapping them on loan, their existing treasury securities, to get cash. Well, on March 11th, that goes away. And based on projections, again, reverse repo also goes to zero sometime in March. And here you can see March is going to be reverse repo ends, bank term funding program expires, the Fed may have to cut, and QT comes to a whopping end. And of course, this is what the Fed said, that on Wednesday they announced the bank term funding program will cease making new loans as scheduled on March 11. The program will continue to make loans until that time and is available as an additional source of liquidity for additional eligible institutions, suggesting that when March gets here and we see the reverse repo get to zero, that now the stress in the banking system could shoot up. And what the problem here is, the banks won't have access to the bank term funding program anymore, which will send them somewhere very publicly noticeable and not in a good way. As the U.S. plans to push more banks to the Fed's discount window, this is a problem. Many more banks, according to Zero Hedge, will have to use the discount window right after the bank term funding program expires, because this is when everything comes to a problem. And can the discount window cope with a sudden need for over $147 billion? Well, last week, usage of the discount window rose $189 million to $2.295 billion. Well, they're saying, what do you think? Could you imagine what this would do to investors and depositors' confidence? All of a sudden, if overnight the banks turned around and pulled $140 billion from the Fed's discount window, it would shatter all expectations that the health of the U.S. financial system is in good shape and would cause outright panic. But now let's turn over to China, because there's something else that's going to draw attention to the U.S. banks. Because remember, these small and mid-sized banks hold a ton of commercial real estate loans, and something in China is going to give investors here that are holding these notes a big reason to panic. As Evergrande liquidation is a big test for international creditors, as we see the liquidation order should have very limited immediate impact on Evergrande's onshore operations or assets, suggesting the company will continue to operate. And while the liquidator will likely be able to assert control over offshore assets, its authority won't be recognized onshore. And Chinese officials have made it clear in the past that they favor the completion of unfinished property projects and paying off contractors over creditor interest, a priority seemingly backed by Evergrande. So that's not the only issue here, is that some people aren't going to get paid back. But you think about it from the U.S. commercial real estate issue. What is we've not seen yet is a massive devaluation in these properties. But what's going to happen when Evergrande goes to liquidation, they start selling things off at pennies on the dollars? Well, it's going to put everything in perspective, that the value of these assets that these banks are sitting with massive loans are across these property developers in China are worth far less. It means you're now starting to put the Chinese banking system in a position of major insolvency, which will then frighten people all around the world to say who is next. Well, we already know who that is. And that's the U.S. small and mid-sized regional banks who are sitting on a mountain of commercial real estate that has yet to be revalued. And if it gets even cut a little bit, well, now those banks are indeed insolvent without any access to money other than the Fed window. And next thing you know, everybody starts to panic in a big way. And this is now coming back to some more problems as we look over to the Red Sea shipping crisis. You say, well, what does that have to do with the banks? Well, let me make the case, because it's sending tremors through the Asian fuel markets. And of course, that is what the problem is the banks, remember, how do they create money? Through lending. Well, let me show you the relationship here between the energy markets and what's going on in the banks. And it doesn't suggest that anything good is coming, because given the upsurge in freight costs, there are signs that fuel producers are having to slash cargo prices in order to keep supplies affordable for customers amid, here you go, lukewarm buying interest for gas, oil, and jet fuel, meaning demand in the global economy is declining. And from a banking perspective, this is a big issue, because again, it comes back to, how is new money created? Well, that's when banks lend. But how is money destroyed in the system? Well, when banks aren't lending enough to keep up with a number of loans paid off. And sure enough, that's exactly what's happening now, as commercial industrial lending is contracting at 1.7% year over year and still moving to the downside. And so we talk about how this could bring back the resumption of QE. Well, if the belief is that QT destroys deposits, that means QE creates them. You can see the banks start to hemorrhage, blow apart here, and the Fed has no choice but to slash rates and bring QE back to keep the U.S. banking system from outright collapse. And despite the fact that oil prices did pop up over the recent attacks, what we can note is OPEC Plus exports indicate slow start to new oil cuts, suggesting that they're not eager to cut prices at all or cut production, because here's the issue here is the global economy is indeed slowing down, and it doesn't matter whether there is pumping out too much oil or whether there are attacks. Any move higher in oil in the short term is being met by further downward moves. And let's look at this from the banking system's perspective, because as we see economic demand go down, using the energy sector as a proxy, where oil prices go on a year-over-year rate of change, as we see here in red, what do you know? Commercial industrial lending continues to go down. We see that here in the 90s. We see that here going into the dot-com bubble. We see it in the middle of the global financial crisis. We see it happen going into what almost was a globally sinking synchronized recession between 2014 and 2016. We see as the global economy was heading into recession prior to the pandemic. And guess what, my friends? It's happening again. And everything is pointing that the banks are going to have a major problem. And this is why it's going to push investors into hard assets and companies that mine them. Like our sponsor of today's show, Caliber Mining. Again, you can find them on the OTCQX under the symbol CXBMF, on the TSX under the symbol CXB. Check them out. Everything in the pinned comment description below. And let's take a look, because this company is setting up to make a major move over a recent acquisition, as some buyers have stepped in that are looking to propel the stock higher. Caliber and Marathon announced, this is back in November of last year, a combination to create a high-growth, cash flow-focused mid-tier gold producer in the Americas with an expected annual production of 500,000 ounces. And the combined company will have a strong balance sheet of combined cash of $148 million and significant free cash flow generated from Caliber's existing mines. The financial strength is expected to facilitate the seamless construction of Valentine Gold Project and a continuous flow of exciting discovery and resource building drill results from Nicaragua, Nevada, Newfoundland, and Labrador. And going forward, this is now done as Caliber completes its acquisition of Marathon. This just happened days ago. And as a result, Caliber has acquired 100% interest in Marathon's advanced stage Valentine Gold Project in Newfoundland and Labrador, one of the top mining jurisdictions in the world, making them a powerhouse in the mid-sized space. And I want you to look at their stock, because people who knew about this and knew about what it meant for the company came in, have been buying up the stock, and they're about to send this thing a whole lot higher. The best part is you can still have time. And here we can see, looking at Caliber stock, you know that their price came down, and what happened, buyers stepped in here right around this 89-cent range, and the next time it got down here, they stepped in a big way. Sellers were saying, we don't want it. The insiders were saying, look, we know exactly what this merger is going to mean and this acquisition. The next time it came down this range, they bought some more, and here recently, they were buying big ahead of that announcement, and sure enough, the stock is moving higher. But look at where the volume profile line is. It tells you the purchase price that most of these big players are picking it up is around 92 cents a share. And remember, this is a cash flow positive company with money in the bank. This is a company well positioned to take advantage of that Valentine deposit. And here you can see a move 15% higher takes us to this upper supply zone where price has been many times. A breakout of that would send it up 32%. And if we zoom into the 90-day chart, it becomes very apparent every time it got down to the supply zone. Those who knew what was coming and what it meant for this combination, this acquisition, for what is going to bring Caliber to further levels of success, well, they bought in a big way, and now they're getting ready to see that stock go higher and work out all of those shorts. Again, what we see as a 15 to 32% move higher in their stock. But as always, with any company we feature on their show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.